Welcome to the Deep Dive. Our mission today is to give you the most concise yet comprehensive analysis of the recent Q2 fiscal year 2026 earnings call for ELF Beauty, ticker ELF.
Yeah.
This was a really complex quarter that immediately preceded one of the most brutal stock sell-offs we've seen from them.
It was a fascinating paradox, really. The quarterly results themselves were, mixed, but not terrible.
Right.
But the guidance that followed was so far below consensus that it instantly invalidated any optimism. For a company that's all about hypergrowth, the market is signaling a huge recalibration.
We have to figure out why. So let's start with that immediate snapshot. On the top line, revenue came in at $343.9 million.
Which was a miss.
It was a miss, yeah.
Yeah.
About 6 to 7% below what the street was looking for. But, and this is key, that number is still 14% year-over-year growth.
Which extends their streak to, 27 quarters?
27 consecutive quarters of net sales growth. It's astounding.
So, the growth engine is definitely still running. But here's where it gets confusing. They actually beat on the bottom line.
They did. Adjusted EPS hit 68 cents.
An 11-cent beat against consensus. So you have double-digit sales growth, an EPS beat, and yet the stock plunged over 35%.
So the market just completely ignored the quarter.
Completely. The forward commentary just delivered a much, much more painful message.
And that plunge tells us the market smelled fear. And that fear came from one place: disappearing profit.
Right, which takes us straight to margin compression.
Gross margin fell 165 basis points year over year to 69%. So what was the primary villain behind that decline?
It was a tariff shockwave. Management was very direct about this.
They pointed the finger right at it.
They did. The weighted average tariff rate on their China-sourced goods is spiking towards an estimated 60%.
62% is just an astronomical rate for a mass market brand.
It's a huge fixed cost that just appeared overnight. Management said it's over $50 million in annual costs.
A material, non-organic headwind.
Exactly. So to fight that, they pushed through a $1 price increase across the whole portfolio effective August 1st.
That was a necessary move, but it brings up a big question, right? How elastic is their consumer base?
That's the billion-dollar question. Their whole identity is built on value.
So do they give any evidence that consumers are just absorbing that price hike?
They seem pretty confident. They stress that even with the hike, a $6 product is now $7. 75% of their products are still $10 or less.
So they believe their average price point around $7.50 is still going to win over consumers who are down trading from prestige brands.
Right, but you can see the tax on the business. Despite that 14% top-line growth, adjusted EBITDA still dropped 4%.
So the tariffs and the investments are basically eating all the profit.
All of it. And the only thing that really provided growth to offset that was the new acquisition, the Rhode brand.
Rhode is the centerpiece of their new multi-brand platform strategy.
It is, and it's contributing a lot to the top line. $52 million in Q2 alone.
That's 17 percentage points of the total sales growth. Management was thrilled, especially with the launch at Sephora North America.
Yeah, they said it broke the previous record launch by 2.5 times. So the consumer demand for that brand is clearly there.
And the scale is huge. For the full year, Rhode is expected to bring in $200 million in sales.
Or about $300 million on an annualized basis. And what's fascinating here is that Rhode historically had great margins, over 30% EBITDA.
So it should be immediately accretive to the bottom line.
It should be, but it isn't.
And that, right there, brings us to the core disconnect, the part that triggered this massive sell-off. Let's get into the revised full-year guidance.
The shortfall was just dramatic. Net sales guidance reset to $1.55 to $1.57 billion.
Well, short of the $1.65 billion consensus.
But the real shock was adjusted EPS guidance, $2.80 to $2.85.
To put that in perspective, they just did $3.39 last year.
And the street was expecting something like $3.50, $3.60. So this is a huge step down.
Which raises the critical question for you, the listener.
Mm-hmm.
How does a company projecting a 10 to 20% sales growth guide for an actual EPS decline?
It's a combination of two things. One, those fixed tariff costs we talked about. And two, a massive strategic choice to invest.
Investment over profit.
Exactly. Management is consciously choosing to pour money into marketing, They're targeting 24 to 26% of sales.
That's a huge increase.
A huge increase for the second half. And they're building out infrastructure mainly to globalize Rhode. They are stuffing the top line, but letting the bottom line suffer this year.
And beyond the Rhode investment, we have to look at the core ELF brand itself. Excluding Rhode, organic net sales were actually down.
Down about 3% in Q2. And for the full year, they're only guiding to 3 or 4% organic growth for the core brand.
That feels incredibly soft for a name we associate with hypergrowth.
It is soft on paper, but you have to understand the mechanics here. They stress the difference between consumption and shipments.
Okay, explain that.
They're cycling massive distribution gains from last year. You know, when they first stocked all those new shelves at Target and Dollar General?
So you're comparing this year's regular restocking against last year's huge initial stocking orders.
Precisely. That comparison always makes shipment growth look soft, but they said core brand consumption, what you are actually buying in the store, grew 7%.
7% is 3 times the category growth.
Right. So they gained 140 basis points of U.S. market share. That underlying demand is still very, very strong.
So if we zoom out, we see a company trying to become a multi-brand house. It's ELF, it's Naturium, and now Rhode.
Absolutely. And building that global platform takes a ton of upfront cash, which is why the stock reacted so violently when the market realized they were going to spend heavily no matter what.
The market reaction was just extreme. I mean, the stock dropped 21 to 26% right after the call.
And kept going. It far exceeded what the options market was even pricing in, which is only about a 13% move.
So when the actual drop is 35% and the expected was 13, what does that tell you?
It tells you the stock was crowded long, a lot of people owned it, expecting the same old story. When the bad guidance hit, it triggered forced selling, rapid de-risking, and a major implied volatility crush.
But strategically, the beauty category still favors them. Consumers are down trading. They're looking for value.
The fundamental consumer behavior is on their side. The whole story now depends on future catalysts. The global rollout of Rhode, tariffs stabilizing, and shipments eventually catching up to that strong consumption.
All right. This is not financial advice, but for those of you looking at this volatility, this sell-off creates, well, a pretty compelling setup.
The punishment was just so extreme. The stock is being priced for a catastrophe, even though core consumer demand and the new growth engine, Rhode, are actually intact.
So it's a classic opportunity to monetize the panic.
And the volatility crash that follows it.
So let's break down a trade idea. The goal is twofold. Capture that fear premium, and then position for a technical bounce.
Okay, so the first part is defensive. You're harvesting premium, betting against another massive crash. You could do that by selling a far out of the money put spread.
Relatively short term.
Yeah, expiring in maybe 30 days. You collect that high premium from the remaining fear, but your risk is defined. You're betting it won't crash another 20% from here.
That's the defensive move. What's the offensive move? The bet on the bounce.
The offense is a medium-term call position. You'd buy a call option or a call spread to define the risk, maybe 60 to 90 days out.
And the target.
You're betting on a mean reversion bounce back towards that pre-call $85 to $90 range. The idea is that once the market digests these temporary headwinds, it has to re-rate the stock based on its real growth.
So our final takeaway here is pretty critical. ELF is navigating a major strategic pivot.
A huge one. They are actively choosing long-term market share over short-term profit, all while absorbing these massive 60% tariffs.
Which results in this really painful transition year where the bottom line actually contracts, even as the top line is growing at a high teens rate.
And you, the listener, have to decide if you believe the long-term benefit of that multi-brand platform is worth the short-term pain.
Thank you for joining us on this deep dive into the ELF Beauty earnings call. We encourage you to consider those long-term strategic choices versus the near-term cost burden of this high-growth story.